Your building's management company has more control over the financial health of your property than almost any other single factor outside your own mortgage. They set your service charge, choose your contractors, manage your insurance, maintain the building envelope, and determine whether the property you own stays mortgageable, saleable, and financially predictable over the years you own it. When they do this well, you barely notice they exist. When they do it badly, the consequences land directly on you in the form of escalating bills, deferred maintenance that becomes emergency repair, and in the worst cases, a property that becomes difficult or impossible to sell because the building's records, finances, or physical condition can't withstand conveyancing scrutiny. In the next few minutes, I'm going to walk you through 7 warning signs your building's management company is failing you, what each one actually means in practice, and what leaseholders can do about it. I've been tracking the UK property market for years, and poor building management is one of the most consistent sources of financial damage to flat owners that sits almost entirely outside their direct control. Let's get into it. It's worth framing the scale of this problem before going into the specific signs. There are millions of leasehold flats in England and Wales, and the quality of building management across that stock is genuinely variable in a way that has significant financial consequences. A well-managed building holds its value, remains mortgageable, produces predictable service charge costs, and presents no surprises during conveyancing. A poorly managed building quietly deteriorates, accumulates deferred maintenance costs, creates uncertainty about the reserve fund position, and generates conveyancing complications that affect every leaseholder's ability to sell, not just the ones who raised concerns. The leaseholder in a poorly managed building is financially exposed in ways they may not discover until the exposure becomes an immediate problem. Before going through the 7 signs, it's worth being clear about the structure. In most leasehold buildings, the management company is either appointed by the freeholder or is the freeholder itself operating through a management arm. In buildings where leaseholders have exercised their right to manage, the management company is controlled by the leaseholders themselves. The distinction matters because it determines who has the power to change the management company when it's failing and how much legal leverage leaseholders have to demand accountability. Everything below applies regardless of structure, but the remedies available to leaseholders differ significantly depending on whether they're challenging an externally appointed manager or correcting failures in their own right to manage company.
Warning sign number 1. Service charge accounts that arrive late or not at all. Under the Landlord and Tenant Act, leaseholders have a legal right to receive audited or certified service charge accounts within a specified timeframe after the end of each accounting year. A management company that consistently fails to produce accounts on time, produces them years in arrears, or produces accounts that are uncertified or incomplete is failing a basic legal obligation, and more practically, is making it impossible for leaseholders to verify what their money has been spent on. Late accounts are one of the most reliable early indicators of a management company in financial difficulty or operating without adequate administrative systems, and in both cases the consequences for leaseholders can be significant. The practical effect of not having current, certified accounts is that leaseholders cannot verify whether their service charge contributions were applied to the building or disappeared into general overhead, cannot assess whether the reserve fund is being built appropriately, and cannot identify overcharging until years after it occurred, by which point recovering overpayments through the tribunal becomes considerably more complex and less certain. Warning sign number 2, an inability to produce a current reserve fund statement on request. Leaseholders are entitled to know the current balance of any reserve or sinking fund that their contributions have been building. A management company that is evasive, slow, or unable to produce a clear, current reserve fund statement is either keeping inadequate records, has commingled the reserve fund with operational funds in a way that makes the balance unclear, or has used reserve fund money for purposes it was never intended for. Any of these situations represents a serious failure, and the absence of a clearly ring-fenced, clearly documented reserve fund exposes leaseholders to the risk of major works bills arriving with no accumulated buffer to soften the impact. A building with a properly maintained, clearly documented reserve fund can absorb a significant unexpected repair without needing to issue a large special levy. A building with a depleted, mismanaged, or simply undocumented reserve fund cannot, and the cost lands on leaseholders who have often been contributing to a reserve fund for years without knowing whether their contributions were being appropriately held.
Warning sign number 3, maintenance that is visibly deferred or ignored. You live in or visit your building. You can see what's happening to it. A management company that is failing will typically show that failure physically over time. Communal areas that aren't cleaned at the frequency being charged for, exterior paintwork deteriorating beyond normal wear, guttering blocked or damaged without repair, lighting in communal areas left unfixed for extended periods, and routine maintenance tasks that require repeated reporting before they're addressed, if they're addressed at all. There's also a longer-term consequence to deferred maintenance that is easy to miss in the moment. A building where minor maintenance is consistently deferred accumulates a growing inventory of items that, left unaddressed, escalate from routine maintenance into significant repair. A blocked gutter left for 2 years causes water ingress. Deteriorating window seals cause damp. Neglected flat roof upkeep leads to structural water damage. Each of these escalations is more expensive than the original maintenance task by a significant multiple, and the costs of those escalations lands on leaseholders through the service charge or through a Major Works Section 20 notice, neither of which is the management company's money to spend. Warning sign number 4, insurance documentation that is difficult to obtain or incomplete. Your building's block insurance policy must cover all leaseholders, and all leaseholders are entitled to see evidence of current, valid insurance coverage. A management company that is slow to provide insurance documentation on request, that provides documentation that is clearly outdated, or that cannot explain what the policy covers, what the excess is, and how claims are made, is failing in one of its most fundamental obligations. Insurance gaps can have catastrophic consequences for individual leaseholders, and in buildings where cladding or safety issues exist, the insurance position is particularly critical because coverage for these buildings is increasingly specific, expensive, and limited in ways that require active management rather than passive renewal. Warning sign number 5, major works being instructed without proper Section 20 consultation. As covered in an earlier video on this channel, management companies carrying out major works above the per leaseholder threshold are legally required to consult leaseholders through the Section 20 process before proceeding. A management company that skips this process, rushes it in a way that prevents meaningful leaseholder participation, or consistently uses a single contractor without competitive tendering is either unaware of its legal obligations, deliberately circumventing them, or operating in a way that prioritizes speed or convenience over leaseholders' legal rights. The financial consequence for leaseholders of inadequate Section 20 consultation is that they lose the ability to challenge the reasonableness of the costs at tribunal, which is the primary legal protection leaseholders have against inflated major works charges.
Warning sign number 6. The managing agent is unresponsive to written communications. A well-run management company will respond to written queries within a reasonable time frame, provide specific answers to specific questions, and maintain clear communication records. A failing management company will be slow to respond, provide vague or deflecting answers, lose track of previous communications, or communicate primarily by phone in ways that leave no paper trail. The absence of a clear written record of communications between leaseholders and their management company is a practical problem in any dispute, because the resolution of service charge disputes and management failures typically depends on what can be documented, and a management company that avoids creating documentation is, consciously or not, making it harder for leaseholders to establish the factual basis for any challenge. Leaseholders should treat every significant communication with their management company as something to be conducted in writing, even if the management company prefers phone calls, because the written record is the practical foundation of any formal dispute resolution, and without it, the management company's account of events is as valid as the leaseholders in any tribunal proceeding. Warning sign number 7. The building's financial position cannot withstand conveyancing scrutiny. This is the warning sign that reveals the cumulative consequence of all the others, and it's the one most likely to materialize at the worst possible moment when a leaseholder is trying to sell. When a buyer solicitor requests the management information pack for a leasehold property, they receive a standardized set of documents, including the service charge accounts, the reserve fund balance, current insurance details, details of any Section 20 notices or major works in progress, and information about any disputes or tribunal proceedings involving the building. A building managed by a failing management company will produce a management pack that raises questions the buyer's solicitor is duty-bound to follow up on, and that the management company is often unable or slow to answer. Sales that collapse or are significantly delayed because of a problematic management pack are more common than most sellers realize, and the underlying cause, poor management over an extended period, is not something that can be fixed quickly once a sale is in progress.
Now, here's what connects all 7 of these warning signs. Each one is individually addressable through formal legal mechanisms: the first-tier tribunal for service charge disputes and management quality challenges, the right to request information under the Landlord and Tenant Act, and in more serious cases, the right to apply for the appointment of a new manager through the tribunal.
But each of these mechanisms requires leaseholders to act collectively, document their concerns carefully, and in many cases invest time and modest legal costs in a process that can take months. The management company that is failing benefits from leaseholder inertia in the same way an underperforming freeholder does, because the path of least resistance for any individual leaseholder is to pay the bill, absorb the frustration, and hope things improve, rather than to initiate a formal challenge that requires coordination with neighbours who may have different priorities or different levels of concern. Collective action among leaseholders is therefore both the most powerful tool available and the most difficult one to initiate, because it requires a shared assessment of the problem and a shared willingness to invest time in a process whose benefits, a better managed building, are distributed across all leaseholders equally, rather than flowing specifically to the ones who did most of the work. Here's what nobody puts together properly. The warning signs in this video are most commonly found together rather than in isolation. A management company that produces late accounts is typically also deferred on maintenance. A company that can't produce a reserve fund statement is typically also inadequate on insurance documentation. And a company that skips Section 20 consultation is typically also unresponsive to written communications. When multiple warning signs are present simultaneously, the appropriate response is not to address each one individually, but to assess whether the management company as a whole is capable of meeting its obligations, and if not, to begin the process of replacing it rather than managing around each specific failure in perpetuity. The right to manage process, which doesn't require proving wrongdoing and is available to qualifying leaseholders in most buildings, is specifically designed for exactly this situation, and many leaseholders who've gone through it describe it as transformative in terms of the building's management quality once they control the appointment of their own managing agent. Here's how this plays out for leaseholders who don't act on the warning signs. They absorb each individual failure as an inconvenience, pay the service charges without scrutiny, and discover the cumulative consequence only when they try to sell or remortgage and the building's management history becomes visible to an outside party for the first time. At that point, the options for addressing years of accumulated failure quickly enough to save a specific transaction are extremely limited.
Here's how this plays out for leaseholders who do act. They document warning signs in writing as they arise, request information they're legally entitled to rather than assuming it will be provided voluntarily, raise concerns formally and in writing rather than verbally, and where multiple warning signs are present, engage with other leaseholders to assess whether collective action through the tribunal or through the right to manage process is warranted. The tribunal route for replacing a manager who has failed in their obligations exists precisely for this situation and is accessible to individual leaseholders without specialist legal representation in many cases, though taking advice before initiating the process is generally worthwhile. If you're a flat owner and any of the 7 warning signs described in this video apply to your building, the most valuable immediate step is to put your concerns in writing to the management company and request specific written responses, not a phone call, not a verbal reassurance at a residents' meeting, a written letter or email sent to the management company's registered address, asking specific questions about accounts, reserve fund balance, insurance documentation, and any outstanding maintenance issues. The response, or the absence of one, tells you considerably more about the management company's capability than any amount of verbal communication, and it begins the paper trail that any subsequent formal challenge will depend on. Keep copies of every communication, dated and organized by subject matter, because if you eventually take a service charge dispute or management challenge to tribunal, the strength of your case will depend almost entirely on the quality of your documentation rather than on the subjective strength of your grievance. The management company you probably never think about has more power over your financial position than you might realize. 7 warning signs tell you when that power is being exercised badly. The question is whether you see them clearly enough to act before the damage becomes the kind that takes years to undo.